A special thanks to Noah for sponsoring this podcast episode. Use code BAGEL for a 7-day free trial, plus 37% off the annual subscription fee, and start listening to business articles from the world's leading publishers today.
In general, investing in revolutionary technology is a really bad idea. You tend to get really, really poor returns.
So many research reports are just the repeat of old research reports in new time frames. And yet it's so difficult to draw conclusions about what you're actually seeing in the space.
You got to remember, market efficiency is a model. It's kind of like what you were just saying. It's a model. It's not reality, or we wouldn't call it a model. And weird stuff is going to happen.
When you go down to the investor level, it's actually worse performance than the active mutual funds.
The whole story of gold as the original money, or true money, or hard money, or whatever you want to call it, is objectively wrong.
Ladies and gentlemen, welcome to the Plain Podcast. We're back with another in-person interview, this time with another fellow Canadian. I'm taking full advantage of my Ottawa-based setup to have on another well-known investment YouTuber within the Ottawa area, Mr. Ben Felix. Ben Felix hosts the Common Sense Investing YouTube channel, now just kind of called Ben Felix. I'm not sure what the branding is on that.
I don't know what's
both,
going on
a bit of both,
either.
But also works as a portfolio manager. So works as a professional in the industry, has all the letters after his name: MBA, CFA, CFP, and CIM. And he is the head of research for Wealth Manager here in Ottawa. You also have your Rational Reminder podcast, which is kind of the podcast extension of what you cover on your channel. And for those who haven't stumbled upon your YouTube channel, it's a lot of research. One thing I like about your content is all of your videos kind of throw in like at least a handful of research papers talking about what academics and what researchers have found about different investment strategies, about markets over different time periods. And so it makes for a really informed conversation about different topics. You know, you can talk about the theoretical as much as you'd like, but having the numbers there makes for a really interesting conversation. And for those sharp-eyed viewers who have been with us for a while, you might know that this is our second collaboration, if you will. We did one way back when. Back when we were both kind of smaller channels. Yeah. On the Grossman-Stiglitz paradox, which talks about kind of the relationship or the tug of war, if you will, between active and passive management, which Ben Felix yourself kind of an advocate of passive management and sort of that application of stuff. So Ben, lengthy introduction, but thank you for hopping on the podcast. I really appreciate it.
Great to be here, Richard.
First question, we'll just hop right into it. How tall are you?
I'm 6'11".
Yeah, it is. Look, I'm a tall dude myself. I'm 6'2", and you tower over me. It's actually nuts. Have you ever played basketball?
I played NCAA Division I basketball.
No kidding, I didn't know that. Yeah. Wow, that's huge. That's funny. Yeah, it's. I remember the first time because we met up for coffee when we both realized we were in Ottawa, and it was funny. I was like, oh wow, a lot, because you only ever see you from the shoulders up, kind of. So, in terms of what we'll cover today, I want to keep it very broad and talking about. A bit about active and passive management and the relationship there, because you talk about that a good amount on your channel. Yeah. And we'll talk a bit about the current market and stuff like that. But to start off, I figured we'd begin. I actually just recently had my coworker on, and we obviously apply a different approach. So I figured you also work as a portfolio manager. Could you explain a bit about what you do as a portfolio manager, also head of research, what that entails, and how your investment strategy might differ from other portfolio managers? Like what strategy you apply with your own investing and what you do for clients?
Oh man, there are 3 questions in there.
So I don't make it easy here. Super unorganized.
As a portfolio manager, I spend most of my time giving clients advice on asset allocation, which I think is pretty typical of many portfolio managers. Maybe the big difference between what I do and what a portfolio manager who is actively managing a portfolio does is that we're making fewer discretionary decisions on individual securities. So my client conversations are much more about their individual financial situation, their financial plan, and how their portfolio interacts with it, as opposed to, and not to say that an active manager isn't talking about that, but our focus is on that as opposed to on portfolio construction, which we consider, and I say this somewhat jokingly, to be a solved problem. We kind of know what a good portfolio looks like, and we can implement that systematically, which is part of our belief system. So that's me as a portfolio manager. Me as a head of research. So you mentioned I talk about a lot of research on my YouTube channel, which I definitely do. I spend most of my research time reading the academic literature. There are some top journals in finance and financial economics that I subscribe to, and likewise there are practitioner journals for portfolio management and financial planning. Spent a lot of time reading that research and figuring out how we can take insights from academia and from peer-reviewed journals and apply that to help our clients make better decisions. So that's me as head of research. And then I guess an extension of that is we have a fairly large team of financial planners and other portfolio managers. So a lot of my time is spent training them on the research that we've done so that they can have better conversations with our clients.
Right. And what would have prompted you to start the YouTube channel? Because obviously it seems like an extension of, and I kind of found this too, the nice thing about working in the industry and having a YouTube channel is kind of just translates over where you cover something for your work. In your case, if you're quite literally doing research for your day job, it makes it easy to have research for videos. But what was the push that made you want to start posting videos on YouTube?
I used to have a blog.
Okay.
When blogging was, I guess it's still a thing, but I don't know. It was
a
cool.
bit less. Yeah, that's a good point. Yeah, it's kind of all migrated to central platforms as opposed to everyone having their own blog.
Yeah.
There are still some out there. I know there's some good ones.
Yeah, a lot of it's shifted to what's the new thing called Substack now.
Yeah, Substack. Yeah, I've seen a few on there. Yeah.
Anyway, so I had a blog. I started writing about investing and financial decision making. Almost 10 years ago now. When I started working in this field, I was doing my MBA at the time. And I just found it was a good way for me to learn and solidify ideas, communicate. And that ended up being somewhat related to me getting my current job. When I applied, they Google searched me and found my blog, and that was a contribution to their decision to hire me. So I continued writing that blog, started writing for my employer's blog as well. And then at some point, we were given the suggestion that, hey, video is going to be a thing,
right.
a big thing.
It's going to be big.
You should do it.
Yeah.
So we as a firm actually decided that we would support people that wanted to create video content. And I just kind of put my hand up and started doing it. And that's it.
Gotcha. Yeah. And it's going strong today. 250,000 subscribers roughly and growing. So yeah.
It's going okay. I don't post as much as I'd like to. On the CSI channel, I put a lot of effort into the Rational Reminder podcast, which I probably learn more from the podcast because the focus on that content is finding the best researchers in finance and financial planning and related fields, likewise happiness and well-being and all that kind of stuff, and interviewing those experts on the podcast. So that, in terms of doing research, that podcast is much more closely related because I'm talking directly to the primary researchers.
Yeah, of course.
So I learn a ton, which is beneficial for me.
Well, yeah, I was going to say, like, that's the thing about a podcast, right? Is it's a 2-person team, right? Where you go in, you prepare stuff, but you also have someone else working with you and possibly sharing new insights that you weren't familiar with. But and I would say your attention to research definitely shows. Ben is the only one who's showed up with notes for my podcast, so definitely the professionalism shows through in everything you do. So on kind of the note of research reports, could you talk a bit about, obviously you're kind of reviewing a lot of research reports. Do you find that out of the stuff you read, like a lot of it comes to the same conclusions, or is there anything that's kind of stood out to you over time? Do you have like a handful of research reports that really resonated with you through kind of your studies of what's been coming out of these journals?
So there are definitely a few things that have been pretty impactful to the way that I think about financial markets and communicate with clients. One of the big ones, which I found really mind-blowing at the time, is the general concept that economic growth and stock returns are at best unrelated and more likely negatively related. So that, I mean, it's really interesting stuff. In terms of the actual papers, one of the big ones is a 2003 paper that was in the Financial Analyst Journal called Earnings Growth to 2% Dilution. And they basically make the case, well, they show that economic growth and stock returns have not been related. And they make the case that the reason is what really matters to investors is growth in earnings per share, which of course you hearing that, it makes sense.
Makes sense, yeah.
That's what it is. But in a fast-growing economy or sector, the new issuance of shares ends up diluting the growth in earnings per share relative to the actual economic growth of the sector or country or whatever. So that was a big learning.
Interesting, yeah. So you're saying basically that the growth doesn't actually compensate for the inflow of money into these areas.
Correct. It's like if there were one single company in a fast-growing sector and they never issued new equity and no other competitors ever came in, you would capture all of the economic growth in earnings per share growth. But the reality is the growing company is going to raise equity capital. They're going to have competitors come into the industry or the sector or whatever, and that's going to dilute growth in earnings per share relative to economic growth. So you can look at a potentially big sector and it can be like, if there were one company, that would be a good investment.
Right.
But there's going to be competition and they're going to need to raise capital. And so you're not going to actually get the economic growth.
That's interesting because I think, like to bring it, and again, I do work on the active side. But when you bring it to kind of the phases of a company, if you will, you can see that a lot with companies as well. Mind you, it's really exaggerated or most obvious during when you have economic booms and busts, for example, like the dot-com bubble obviously sticks to mind as an example of where you have this really high growth area, the internet, obviously very promising, but a lot of companies just attracting as much investor capital as possible and really no earnings to back up what they were selling to these investors. Obviously, some companies did really well, but I didn't know that. That's interesting too, and I guess my follow-up to that would be, how does that relate to, or you as an investor, how does that tie to your view of developing markets and things like that? Because obviously, if you were to take a very high-level, broad view of what people tend to view the markets, it's generally that developing markets, because they're growing, have more opportunity, higher risk, higher return. Do you think that kind of proves that wrong or negates that, or is it just there's something more nuanced there?
Developing being like emerging markets.
Emerging markets, sorry, yes.
Yeah. So there's another paper that when you asked me this question, I had two papers in mind. One was the earnings dilution paper that we just talked about. The other one is a paper called "Is Economic Growth Good for Investors?" And they look at exactly that. They look at what has been the historical cross-sectional correlation between GDP growth and stock returns, and they look at both developing and emerging markets, and they find the correlation is negative.
No kidding. Yeah, so that's interesting.
It's not intuitive, I think, and that's why when I learned this, and there's a whole field of research on this. There's tons and tons of papers. So a lot of them look at the .com situation that you brought up. It's fascinating. Anyway, that's been super impactful for me.
Yeah, and I will say, like, obviously with research reports, it's obviously important not to, saying that there's this relationship that we've seen historically doesn't mean that it's a causal relationship. Like, just because an economy is growing doesn't mean that stocks are going to do poorly. But that's definitely an interesting relationship that obviously makes things a bit more complicated when you consider like how to address that kind of stuff.
Yeah.
So kind of we touched on it a little bit. And I'd actually be interested to go back to what you're talking about with asset allocation in a bit. But before that, we've kind of thrown out the words active and passive passively in our conversation. Most people have a general understanding of what those terms mean. But given, could you maybe explain again to people who might not be as familiar? I guess we'll start with the efficient market hypothesis, because that's kind of the core of it, really, when you get into deciding between those two approaches. So how would you describe efficient market hypothesis and how that relates to active and passive management?
So market efficiency is just the idea that all available current information is reflected in prices. That's it. I mean, it's pretty simple idea.
Right.
If that's true, we can use the information in prices to make decisions about asset allocation and which stocks you might want to own or not own. Mm-hmm. If the market's not efficient, you as the investor can bring information that is not currently in the price to the market and earn a profit for a pretty low risk, because you're the one bringing the information there. Now, on the other side of that, if the market is efficient, the only way to earn higher returns is by taking more risk. And how you measure risk is a whole other question.
Sure. Yeah.
I think it's also important that in an efficient market, prices aren't necessarily always right. In the theory, it's pretty explicit in the theory. The big takeaway there is that when there are incorrect aspects to a price, they occur randomly, and there's no pattern there. So there are pricing errors. There can be pricing errors where a stock differs from its intrinsic value, whatever that is. But those errors are random, so they can't be systematically exploited.
Right.
Now, if that's true, if there are not pricing errors that can be systematically exploited, then trying to systematically exploit errors is a very difficult game to win. And so that's how it relates back to active versus passive investing. I don't love those terms. I think they become very blurred over time. Like what is passive investing?
Sure. Yeah.
I think in general terms, people are talking about owning a market capitalization weighted index when they refer to passive. And I think that's probably as good of a definition as we can get.
Yeah.
Active investing is deviating from the market cap weighted index for some reason. That could be for taking more risk. Like I actually don't consider myself to be a passive investor because
Gotcha.
I do tilt toward in my portfolio, and likewise for our clients at PWL, we do tilt toward higher expected returning stocks. So that's kind of my point about what exactly is passive.
Yeah, that's fair because I think you put it in a good way that like I personally, I've always kind of viewed it as more of a spectrum, if you will, or a scale. Like, you know, on one end you have extreme passive, if you will, which let's say is like owning a market cap weighted index fund that owns every stock that's ever existed, right?
And bonds too. I think that's the thing.
Sure, that's a good point.
What is a true passive investor? You have to own the market portfolio.
That's a very good point. And then, you know, okay, do you include real estate in there? Do you include alternatives or metals or whatever? Exactly. Yeah, that's a great point. Cryptos maybe, who knows? but even if you just focus within stocks, because obviously that opens a whole other can of worms. If you just focus on stocks, on the one end, you would have like passive where you own, let's say, every stock that's ever existed, probably something that will never exist or to some capacity. On the other side, you have extreme active where, let's say, it's someone who's trading every market movement possible within their portfolio of stocks, probably doesn't exist either, or at the very least, you know, isn't very common where you have someone trading every second in their portfolio. So most people obviously fall somewhere between those two extremes, and it's just whether you go more in terms of index or say avoiding security selection versus, you know, maybe owning and timing. And timing's a whole other thing too, right? Security selection, you could have its own scale, timing its own scale. So yeah, that's a good point. It's really not that simple, is it? Like just defining even what those two terms mean.
Yeah, I think another big one to compare the two is portfolio concentration.
In terms of like geography or
anything. I think that with increasing concentration at any level, I was thinking by number of names, but yeah, geography.
Oh, I see what you're saying. Yeah, number of stocks. Yeah, I understand.
Industry could make sense too, and any form of concentration is inherently an active bet because you're carving out everything else in the theoretically optimal market portfolio. Right.
So we kind of touched on it. One question I had for you. So we talked about market cap being more passive, if you will. So one question I've gone a few times and that I haven't always given a very good answer to, quite frankly, is why is equally weighted not considered the passive approach? You know, if you say passive is just owning a bit of everything, why would you not say equal weighted is the way to go? Why would market cap be considered more passive, if you will?
So theoretically, if we take the position that the market is efficient, all assets have been priced and weighted based on their contribution to a theoretically mean variance optimal portfolio. Mm-hmm. If you take the capital asset pricing model perspective of asset pricing. So that's why.
Right.
The largest, most liquid stocks are priced that way for a reason.
Because of their most profitable or whatever.
Whatever it may be.
Yeah, whatever the metric.
So deviating from that is saying I disagree with market prices. But again, we're back to that question of what actually is passive. It would be hard for me to disagree that equal weighting is not also passive. I think it probably is a form of passive investing.
Right.
But what you end up doing there is if you look at just a regular market capitalization weighted portfolio, by weight, most of the portfolio is going to be made up of large cap growth stocks, just because they make up the largest portion of the market,
right?
And much less is in small cap value stocks, which tend to be the smallest segment of the market. If we say we're going to equal weight by name, you're going to end up drastically underweighting large cap growth and drastically overweighting small cap value.
Right.
Now, that's not necessarily a bad portfolio. I would probably rather intentionally design tilts toward size and value and stuff like that, as opposed to naively doing it through equal weighting. But yeah, I think you probably end up with some liquidity issues with equal weighting too, because you end up putting a significant weight in those smallest stocks.
Right. Yeah. And that's a good point too, is you take any position with where you get into smaller and say small cap or even micro cap, you actually get to a point where, especially for a portfolio manager who, let's say, is trading $1 million trades for multiple clients, you might actually have difficulty filling out a trade if you're at a certain level. You know, if you buy a company that has less than $1 billion of market cap, a $1 million trade, you need $1 million on the other side of that selling out of the company. So that's a good point to
liquidity,
touch on.
but the other side of liquidity is that you may fill the order, but you may pay. They may be such
spread.
The spread could eat any premium that you may have otherwise captured,
and which makes it very expensive as well, and almost kind of works against you if you think of the factors you're trying to deal with. And the thing with the efficient market hypothesis is I think there's three kind of, there's strong, semi-strong, and weak form, if I'm correct.
Yep.
And they argue for different levels of how efficient the market is. And within that, it's my understanding has always been that it's not that markets are perfect. It's that there's no reliable, consistent approach to exploit the imperfections, if you will. On that note, I think, especially over the last 2 years, we've seen some examples of that kind of stuff. And, GameStop is the one that comes to mind as something that you can say that they were short selling arbitrage and stuff. And I think there's arguments for that, the fact that this was an arbitrage trade early on. My own view is I think that was a wild event that kind of, again, it doesn't really challenge the hypothesis because the hypothesis allows for errors, but it is to say that it's impacted the efficiency of the market, in my opinion. Do you have that same view, or do you think there's a justification for why GameStop, for example, was bid up to such a high level, or do you just see it as kind of like an anomaly that is hard to predict?
I don't think it needs a justification. I don't know if we need to say market efficiency has changed because of that event. I agree. We're
here for the hard answers, man. We're here to decide the fate.
I had Eugene Fama on my podcast a while ago, and he's like the guy.
No kidding. You had Eugene Fama. I didn't know that. I'll have to go check that.
Episode 200.
Wow. No kidding.
We asked him about this.
Right.
And he laughed and he said, is that thing that happened with the technology stock? I don't know. I don't look at the data until three. He said he looks at the data 3 years later. I thought that was pretty good.
That's funny, yeah.
But he said it's an anomaly. He said you got to remember market efficiency is a model. It's kind of like what you were just saying. It's a model. It's not reality, or we wouldn't call it a model. And stuff weird stuff is going to happen.
Right.
And this isn't the first time weird stuff has happened. If you look back through market history, there have been other weird anomalies where prices shot up in maybe similar-ish situations. So I don't think it tells us anything about market efficiency. If you go back to the actual tests of market efficiency, like do active managers outperform on average? If you look at the data, that hasn't changed. And I don't think that something like GameStop will change that type of data.
Right. So just to quickly cover it, because obviously we're both familiar with Eugene Fama. The Fama French model, could you explain? We've actually covered it before, but could you quickly cover the Fama French model? And from what I know, it actually ties very closely to your own investment strategy in terms of the factors you look at. So could you maybe talk a bit about the Fama French model and how you apply that to your investment strategy?
Yeah. So I mentioned earlier the capital asset pricing model, which is an asset pricing model that relates all risk back to market beta, which is proportional to covariance with the market. So if the market goes up 10% and a stock goes up 20%, and likewise on the downside, it's got a beta of 2.
Right,
if it moves in lockstep with the market, it's got a beta of 1.
A multiplier, if you will.
Yeah. So the capital asset pricing model assumes that all risk is market beta. If that were true, any difference in returns between two diversified portfolios would be fully explained by exposure to market risk, by market beta. Now, we've known for a long time, since the 1970s or 80s, that that's not true, that the CAPM does not explain differences in returns in some specific cases. So early on, low beta stocks that are less volatile in the market, they didn't have returns that were commensurate with their market risk. So that was an anomaly. And then likewise for small cap stocks, they had higher returns than their market betas would predict. Value stocks, same thing. So this was going on for a while, and it was interesting because a lot of literature at that time was saying, hey, look, markets are inefficient. Because if the capital asset pricing model is the truth, if that's how assets are priced, anomalies...
It's obviously wrong, yeah.
Right.
Yeah.
But the model's wrong.
Yeah.
It's interesting. So with market efficiency and with asset pricing models, they're always tested jointly. And it's actually a problem because EMH, efficient markets hypothesis, is still a hypothesis because it cannot be proven.
Right.
And it can't be proven because every test of market efficiency is jointly a test of market efficiency and the asset pricing model being used to test market efficiency.
Right. Good point. Yeah.
Yeah. And that's it's a real problem. Anyway, so people were saying back then, hey, markets are inefficient. Look, value stocks have higher returns than their CAPM predictions. And these guys, Eugene Fama, who have become quite famous as researchers, at least in my finance bubble.
I think everyone, any university student or whatever is going to hear about the Fama French model. So I think it's pretty well respected, and even among active managers, like we've heard of, we know the factors and stuff like that. Yeah.
So these Fama and French guys, they basically said, maybe we just need a better asset pricing model. Maybe this single factor market model, the CAPM, maybe it's not the right model. So let's add, there seem to be these other risks that are being priced into assets. Let's add those to the model and see how the explanatory power changes. And so they added a small cap factor, which is like a risk premium associated with smaller companies, and a value factor, which again, a risk premium associated with lower priced companies. And they were measuring relative price by book relative to market, book value relative to market value or market price. And they found that this 3-factor model explained a lot of the anomalies that were previously in the data.
And you kind of touched on it, value, size. I'm missing the third one.
Market value and size. Those are the 3 factors.
Right.
They've got a 5-factor model.
Yeah. Now they've added factors over time, kind of repeating the research.
Profitability and investment.
Right. So what's investment? What's the investment factor?
How quickly the book value of assets is growing.
Right. I see. And so would you agree that that's kind of the core that you base your own investment philosophy around is that kind of model?
Yep. So we just did a podcast episode on this. Actually, so you mentioned Fama and French have added factors to their model. That is absolutely true. It took them a while to do it. They had their 1993 3-factor model. They had a 2015 5-factor model, and in 2018 they had a 6-factor model, which included momentum. That one's a bit tenuous because.
And from my understanding, it kind of changes, or its influence has changed over time, if I'm not mistaken.
Well, momentum doesn't have a very strong theoretical explanation on the efficient market side. If you believe markets are efficient, why do stocks with momentum
exist? I understand.
Yeah. So Fama and French, they say this in their paper. They reluctantly added it to the model in that paper.
Right.
More recent research, actually, there's a new method for comparing asset pricing models. It's the maximum squared Sharpe ratio. So there's this little body of literature that emerged comparing asset pricing models on that basis. And the most recent paper, at least the one that I'm aware of in that field of study, includes transaction costs. So it's comparing all these asset pricing models, but they're including transaction costs. So Fama and French in 2018 had found that adding momentum resulted in the best model of the set that they were comparing. But this more recent paper by a guy named Robert Novi-Marx, he adds transaction costs. Momentum has very high transaction costs because it's a high turnover strategy.
Right.
And when he added momentum, he found that when he added transaction costs, he found that momentum drops out from the winning factor model.
Hey guys, just a quick pause to once again thank our sponsor, Noah, who offers a really awesome service. And if you are liking this podcast, you might really like what they have to offer. Noah is an app that professionally narrates and curates playlists of business articles from the likes of Bloomberg, The Economist, and Harvard Business Review, not only letting you listen to thought-provoking pieces, but linking articles together on related subjects so that you get well-rounded coverage and multiple perspectives. In fact, they actually have a team of industry experts behind the service, and it really does show in the quality of their picks. So if you'd like to try them out, you can visit the link in the description or use coupon code BAGEL to get a 7-day free trial, plus 37% off the annual subscription fee. Thanks again, Noah, and now back to the episode. With the data that you, from these research reports, is it primarily mutual funds that are used? Is that where the majority of the data comes from?
It depends on the research.
Okay.
So Fama and French have used mutual fund data. A lot of research now is using 13F filings for fund flows data to look at totally different aspects of financial markets. But there's also pretty good research on individual account holders.
Gotcha, yeah.
That's very interesting research. And we can learn a lot about how people make financial decisions, but also what returns do individual investors earn in their own accounts.
Yeah, and funny enough, if my understanding is correct, and you would have more experience reading through the papers than I would, but when you look at the individual side, it's kind of funny because from what I've seen, most people know that actively managed mutual funds on average have seen that underperformance over time. When you go down to the investor level, it's actually worse performance than the active mutual funds, from a lot of papers pointing to that conclusion, basically to the point you kind of touched on, which is the behavioral side of it and the emotional side of it. On the research side, when you talk about biases and stuff like that, kind of same question I asked earlier, but are there any research papers that stuck with you on the emotional side in terms of insights into investor psychology and how that impacts returns, or what were some takeaways kind of reading about that area?
I'm not going to say none, although I think I asked Fama this question too, and I think he said nothing.
Oh, no kidding.
I hope that's what he said, but it was something like that. So when you look at, there's two pieces. There's the empirical piece, which is what do the data say? What has happened in the past? And everybody agrees on that because it's there. It's in the data.
It's the data.
How you explain it, though, that there's massive debate about in academia. You can explain pretty much any anomaly either with behavioral stories, theories, or with risk-based theories. So the Fama and French 5-factor model, 3-factor model, whatever, is a risk-based model. They take a risk-based perspective, which is basically that there are differences in discount rates, differences in riskiness between stocks, and that's what explains the anomalies that exist. There's a whole other field of research in behavioral finance that has very good reasons and explanations for why we see the exact same anomalies, but from a behavioral perspective.
Right, I understand. Yeah.
Now it's important because if they're behavioral anomalies, you aren't necessarily taking more risk by exploiting them. So from a theoretical standpoint, an investor could say, I'm going to go and earn alpha because I believe the market is priced with the CAPM, with the capital asset pricing model.
Right.
And all these anomalies are just behavioral errors of other investors. I'm going to go exploit them. There's an important distinction because you don't have to take more risk if you believe that.
Right. And that's a tough thing with academic papers, right? Is the date... the testing of the hypothesis alone doesn't actually give you the answer of what's happening. It tells you the results, right? And you can tie it to factors and stuff. Kind of a good example of that I saw was, and I'm sure you've heard of this, is the Phases of the Moon paper, which showed basically a correlation between moon phases and stock market performance, showing that the best time to own stocks was during a new moon, and the worst time was during a full moon. But if I'm not mistaken, the conclusion of the paper talked about how the moon was in fact influencing investors. So it wasn't, this wasn't like a paper that was done and the researchers think, that's just an anomaly. There was this explanation provided or presented saying, yep, investors are affected by the phases of the moon. And a lot of people probably would disagree with that and say, that's not true or whatever have you. So that's just an extreme example of the difficulty with taking the academic findings and explaining what's actually happening or what's causing those empirical results. And I've always found that interesting with finance because finance is funny where you actually have unlimited potential for research reports into the future, right? Every day you get more pricing data and so many research reports are just the repeat of old research reports in new time frames. And yet it's so difficult to draw conclusions about what you're actually seeing in the space, which I find funny. Moving on from kind of the discussion on the research side of things, we kind of touched on it earlier. I would actually be curious what your thoughts are on the different asset classes, specifically with crypto. You mentioned you're not specifically let's say a passive investor or, that label. What's your view on kind of those asset classes? And do you see any of the research reports now talking about crypto? Like, is that something that's coming up frequently in the journals that you subscribe to?
Not super frequently, but it's coming up. It's definitely
slowly
coming
but surely.
up.
Right.
Yeah, and not generally in a sort of positive light, at least from what I've read.
Right.
We actually, so a year ago, or not quite, in October 2021, we had Professor Campbell Harvey. You know who he is?
I'm not familiar, no.
Okay, so he's at Duke University. He's a big name in traditional financial economics research. So he was an editor of the Journal of Finance for years, but he's right up there, like top tier traditional finance researcher. He's done a lot of work on emerging markets, actually. That's very interesting research. Anyway, so we had him on our podcast October 2021, and we spent half the episode talking about traditional finance, all the research that he's done, and it was great. The second half of the episode, it's a 2-hour episode, the longest one we ever did. The second half of the episode, we talked about crypto, because he had just written a book on DeFi and the future of finance.
Interesting, okay.
In his view. And coming from him, who's a very respected,
right.
Me and Cameron, my podcast co-host, we kind of looked at each other afterwards and we were like, all right, we've kind of been not ignoring, but dismissing crypto for a while. So after Cam talked about how great it was going to be, we decided we had to take it seriously. And so this year we launched a podcast series actually focused on crypto. So we're
interesting. Okay.
11 episodes in now, and we've talked to a whole bunch of experts from, software engineering, computer science, law, economics, monetary policy, all kinds of these different specialists that have a perspective on crypto. And it hasn't painted a very pretty picture.
No kidding. Interesting. And how does that stand for the longevity of this podcast series?
Well, we'll probably have 15 episodes. It was never intended to be a permanent podcast. We really genuinely wanted to understand the space.
So what are the main kind of shortfalls or roadblocks, I guess I would describe them, that you're seeing from these interviews?
So if you ask a technologist, like if you ask a software developer or a computer scientist, cryptography expert, which we've asked all three of those, they're not very excited about the technology or what it can do.
Right.
It did something kind of cool. So digital cash.
Sure. Yeah. I mean, of course. Yeah. No. And there's no harm in saying that, something interesting and creative was made, for sure.
Yeah. But is it good for society? The answer that we've gotten so far is probably not, which is probably not surprising, because if you look at where Bitcoin came from, it's got deep roots in libertarian ideology. I think it comes from a fundamental misconception of what money is and how it functions in a society, because it was emulated after gold. The whole story of gold as the original money, or true money or hard money or whatever you want to call it, is objectively wrong. So that was popularized by Adam Smith. Just the concept of money coming from barter, evolving from barter, and then we find the most saleable commodity, which tends to be gold, and therefore that's what money is. And the government plays a role of kind of making it easier to exchange gold by stamping it, then eventually they issue currency. But really the government or the central bank or whoever is just there as an intermediary between the people and gold, which is true money. Now that story is objectively wrong.
In what way?
It's been disproven anthropologically. If you go back and look at what were the origins of money, there is zero evidence ever of barter societies. There's
interesting.
Yeah. So the origin of money is not barter. And the origin of money is definitely not gold. So all that, it was quite literally fabricated by Adam Smith.
So what would have been the functioning means of exchange if not barter?
Credit. Money is a social relationship. Yeah, so I mean that's it. Money is credit and always has been credit. The idea that money is a thing, a commodity, is a misconception. And modeling in software something that is designed to behave like that, I think, like I said earlier, is a fundamental misunderstanding of what money is and how it functions within a society. Now that's Bitcoin, but its roots are this libertarian ideal, and anti-regulation, anti-government. And I think it's pretty hard to separate what has stemmed from it from that. We did just talk to somebody on our podcast who we're trying to be balanced. Like we're not
sure. Like at the end of the end, I've kind of said this too, is you don't want to be blindsided by the success of something, right? And you're only like what you or what I think isn't very likely going to change the outcome of what will happen with cryptocurrency. So you don't want to be, pouting on the sidelines the whole time something's succeeding, but you were saying about this.
So we came to this thing with an open mind, and we haven't released this episode yet, but I think it's coming out next week as of when you and I are recording this.
Right.
So we had somebody who's a proponent of crypto, but he's a researcher. He's got a PhD from the University of Toronto. He spent time all over the world researching, focused on cryptography, technology, and cryptocurrencies. For the last 10 years, he's focused on cryptocurrencies. He made the argument that he thinks that we, at this point, can detach what has developed into Web3 and DeFi and all that kind of stuff from the libertarian roots of Bitcoin. I don't know what I think about that yet. It's hard because it's designed as a technology to remove intermediaries. Intermediaries serve a lot of important functions, particularly regulatory ones, but
especially within financial functions. Yeah,
it's huge. It's huge. Just KYC and AML. And so now we have exchanges, crypto exchanges that are new intermediaries, but now we're back to square one.
Right.
Like, what are we actually accomplishing? We now have a lightly regulated market where people are getting scammed and losing their savings in a lot of cases. What got better?
Yeah. What I've seen a lot of people find out is in trying to build this self-governing system, they realize people have found the shortcomings of it. And that's why DeFi relies on these central exchanges and stuff is to fill those gaps that are very difficult. Because the thing you have to remember with DeFi is this is code that's being produced, packaged up, and then sent into the world. And yes, there are ways to update it after the fact. But over time, we've seen that there are a lot of, vulnerabilities. There are issues that come up and exploitations. And just stuff that some people are happy to change the way they do things to accommodate for those. A lot of people aren't. At the end of the day, a lot of people probably aren't willing to learn this new ecosystem to do the same thing that they can generally do through traditional finance. And it's not to say, and where I kind of keep an open mind is with emerging markets and areas. There was an article I had a journalist reach out about Afghanistan and how there's kind of this youth movement to bring crypto to Afghanistan with the Taliban kind of clamping down on traditional financial systems and preventing the use of foreign currencies and stuff within there. So there are kind of, these unique use cases for these things. When you talk about DeFi and stuff, the problem is the opportunity there to benefit as a holder of these things. When you talk about just holding Bitcoin, like, talking about how great it will be used by other people, but just owning it yourself as an investment, there are limitations there.
Podcast episode that we released today was with Professor Hillary Allen. She's a law professor at an American university, but her area of specialization is financial regulation. And she's written a ton about crypto and DeFi. And one of her comments that stuck with me was that we've seen crypto be very good at pointing out what is wrong with the existing financial system. And that's kind of good.
Sure, of course, yeah.
But her other point is that crypto doesn't solve any of those problems.
Right.
Yeah. It actually makes them worse.
Right. That's a good point because, when you touch on regulation, for example, there are plenty of problems with regulation. And in fact, when you talk about transaction fees, when you talk about the, say, paperwork or the burdens of, let's say, foreign exchange, or even just sending money to a relative, for example, one of the reasons that's expensive is the regulation is like you mentioned KYC. So that's know your client, which is just kind of requirements from professionals to know who you are and why you're sending money, they don't care, but they're required by regulation because obviously if you don't have that sort of functionality, you're going to have a lot of money laundering, you're going to have a lot of issues. So that actually imposes a cost. It's not to say that banks aren't profitable. It's not to say that they don't make money from doing this business, but it is to say that one of the reasons things are slower, things have costs, it's not free to send money around, is because of these regulations. So it's great to say, well, that's a problem. Transactions are slow because there's regulation. But is the solution no regulation,
right,
such as with DeFi?
Right.
So that's a great explanation of it. Yeah.
What does crypto actually do well? It provides the opportunity for regulatory arbitrage. Whether that is a good thing or not is a very philosophical question. I think the answer is probably no, unless we come back to the libertarian roots of Bitcoin, where all regulation and government intervention, other than protecting private property, is a bad thing. And that goes back to John Locke's political philosophy.
Right.
But anyway, for the average person living in the world that we have developed over years of developing laws and regulations and all that stuff, is eliminating regulations with technology just because we have a technology that can do that a good thing? I would generally say no. We had Bruce Schneier, who's a very big name in the cryptography world. Super excited to get him on our podcast, actually. But he said something that also stuck with me. He said that technology does not solve political and economic problems. It just doesn't.
Right.
And trying to do that with crypto is it's something that will eventually fail, because even if you go into a country, say the Afghanistan example, if there's a movement to start using crypto there, the Taliban will crack down on it.
Yeah.
And that can be done at the physical level. They can physically stop you.
Even if they can't. And that's a good point is a lot of people, they assume, well, and there's technical truth in that, Taliban can't take your Bitcoin. But can they raid your house? Absolutely. And that's a good point and it's funny that you mentioned that, because it's almost that the countries, say in Canada, the United States, where cryptocurrency is, I don't want to say less effective, but let's say there's less fundamental demand for that DeFi network. Just as an example, I know that doesn't necessarily apply to Bitcoin, but if you take DeFi functions and you say, cryptocurrency, obviously, DeFi functions aren't as needed in the US and Canada because things are well regulated. Generally speaking, private property is protected. You have these a stable government, more or less, and yet that's so it's not as needed. And when you go to the countries where that stuff would be more valuable, it's actually less protected from those threats, if you will, from unstable government and things. But it's funny because the advocates in North America are the ones who are strongest, beating the drum, saying that we need this, when really we have the best market to not have it, right? Is this market where you have these protections and things like that. I have this one professor who it always kind of stuck with me. He called it the engineering problem. I don't know if that's actually like a technical term for it. But the idea of being able to make something incredible and beautiful from an engineering perspective. And I think it was kind of in reference to Silicon Valley, and having it flop because the engineers didn't actually solve a problem. They made something beautiful, they made something technically sound and perfect, and the end user didn't care about it. Because the average person doesn't put a lot of thought into the philosophy of libertarianism, and it's not to say that those discussions aren't important, but it's to say that at the end of the day, people care about convenience, people care about, the safety of their things. Those probably trump the technicality of how the thing is working. Again, I try to keep an open mind in the sense of we might see interesting stuff develop, and we might see more useful stuff develop, right? As you don't want to turn a blind eye to that stuff. My criticisms have largely been in the promotion of it as an investment class, namely in terms of, you could argue about investing in general. But in terms of, obviously, you have the people who claim very large returns and, this will revolutionize money, like you kind of touched on. We haven't had much evidence that is the trajectory.
No. So you asked earlier about good financial economics research in crypto. One of the papers that I really enjoyed, and we had him, it was the second episode of our crypto podcast, a guy named Igor Makarov. He did a paper called Blockchain Analysis of the Bitcoin Market, where they built algorithms and got other blockchain analysis service providers to help them look at what is actually going on in the Bitcoin blockchain. Who's involved, how many people own most of the coins. It's very few people own most of the coins, which is interesting. But one of the things that I found really interesting from his paper is what are people actually using Bitcoin for? And the single largest use is speculation. And that lines up with another paper that the data is a little bit older. Igor's paper was pretty new. But there was another paper that used, I believe it was German data from a bank, where they looked at people who ultimately ended up investing in crypto. But the interesting thing is that they had data about their investment accounts before they invested in crypto and then for a brief time afterwards. So they were able to look at what were the characteristics of crypto investors before they invested in crypto. In other words, what were they investing in prior to investing in crypto? And this is a paper by a guy named Tobin Hanspal and some co-authors. And they basically found that crypto investors were the type of investor that was previously investing in highly speculative stuff. They were turning their accounts over often. They were investing in lottery-like stocks. That's tends to be small cap growth stocks with low profitability.
Right.
But they've got lottery-like distributions.
Right.
Now, what's interesting is that we talked about asset pricing models earlier. You can't apply an asset pricing model to crypto because it doesn't have firm characteristics.
Right.
But there's a concept called demand system pricing. It's like, what can we learn about who's investing in assets? And I think from that perspective, if the same type of investors that are investing in highly speculative stocks are also investing in crypto, it might indicate that the behavior of crypto as an investment will be similar to those types of stocks. So between those two papers, it seems like it might be reasonable to think that crypto is going to behave like any
lottery style stock.
And it happens in what seem to be revolutionary technologies. I think we saw this with the ARK funds too. Everyone gets really excited about stuff, and you end up with a whole bunch of small stocks with ridiculously high prices that do very well for a while. You win the lottery for a bit, but it doesn't tend to last.
Right. Yeah. Yeah. And I mean, people are calling it the crypto winter right now. Only time will tell how things recover over time. But certainly, you mentioned ARK, electric vehicles is an area there. And, you have Tesla doing well right now. But you have to remember all the startups that were in the EV space, before Tesla Tesla was always kind of dominant in that space for the past few years. But all to say that when you have these technologies, you always have a lot of duds that show up and make it risky in terms of a broad allocation to the space. So I can gather that you probably aren't including crypto as a asset class in your allocations.
No, we're not.
Not yet.
There's a firm that I respect a lot that did that about a year ago, I guess. And it must be hard now telling, like, how do you have that conversation with your clients? We talked briefly just now about the technological revolution type investments in general. And this relates back to the research on the relationship between economic growth and stock returns. In general, investing in a revolutionary technology is a really bad idea. You tend to get really, really poor returns. And I think it, at least in terms of a mental model, it's probably safe to think about crypto like that. Even if it's not going to be realized as a revolution, we may not look back on it and say this was revolutionary. But even if we are going to look back on it and say that,
even if we do have something stick, I see what
it's
you're saying.
It's not a good investment,
right?
Lots of reasons that I wouldn't touch it.
That and again, it's I feel like it's a cliche for my channel at this point to bring up the .com bubble, but it's just such a good example of that perfect thing where the internet was revolutionary. It didn't mean an investment in the average internet. In fact, an investment in the average internet company would have done you very poorly. That's right. If you were to hold a basket of internet stocks through the .com bubble, boom and bust, you would have probably lost a sizable amount of money.
Yep.
Because it was a terrible investment as an asset class for a sector, if you will, for some time. We're kind of getting to the end of the podcast time I have allocated anyway. I don't want to keep you too late on a Friday afternoon. But I figured we could end. Obviously, you've mentioned kind of a few sources that you use. I like to ask guests any tips they have for people trying to learn about investing and given kind of the research you do. I figured we could end on if you have any resources you could offer for, or maybe even just what you like to browse when you're reading research reports? What are the sources you like to refer to? And then any tips for someone who, let's say, wants to be the next Ben Felix, who head of research at maybe not that specific role, but someone who wants to see more of the academic side of investing, see these research reports. Do you have any tips in terms of increasing your exposure there, increasing your education, and even maybe entering the workforce in that area?
Yeah. So the top journals in financial economics are the Journal of Finance and the Journal of Financial Economics. You probably don't want to read them. They're like super technical.
Well, it's just blatant research reports, right? So
it's like hardcore research. Like these are guys that are, they could have been aerospace engineers, but they went into finance. Or they are.
I can advocate for that because I had a subscription for some time and I don't currently have a subscription. I like to poke and I look through some of the free offerings sometimes.
Yeah, so So those journals are the top journals. I subscribe to the Journal of Portfolio Management, which is not a top journal. I don't think it even ranks from that perspective of like journal quality rankings. It's terrible. But it's a practitioner journal. I think it's great in terms of relevance. It's all paywalled though, which is unfortunate. And the subscription is actually kind of expensive. But the good news is all three of those journals, typically the authors will post the final draft version of their paper on a website called SSRN, which is free for anybody to access.
Right. Yeah.
So it'll usually say, if it's a published paper, it'll say forthcoming in whatever journal.
Right.
I try to focus on peer reviewed journals. Like if it's been published, you can be more sure that it's good research.
Right.
Sometimes I'll let that slide a little bit. If it's from Fama and French, for example, I'll generally believe that it's probably fine.
Right.
But still, I always prefer peer-reviewed research. So SSRN is great to do portfolio analysis with like factor models and the stuff that we talked about. There's a website called Portfolio Visualizer.
Right. Yep. Yeah, great tool.
Free tool. It's really quick to run a 5-factor regression, which is a type of analysis that lets you see how much of a portfolio's return is explained by exposure to the different risks that we talked about briefly earlier. So I find that to be a useful tool. Those are the two big ones in terms of free tools for research.
Yeah, I might be mixing up my tools here, but that's one that I've used a lot. And actually at my company, we use it sometimes. Again, I might be mixing up the tools, but with for clients who hold multiple mutual funds, one thing I like is it will show you the overlap of because it's false diversification. There's some papers on that as well where a lot of people get this sense of calm or sense of assurance when they hold multiple mutual funds, even though at the end of the day they tend to have like a ridiculous amount of overlap, say like 75% overlap in terms of the actual positions that are held. So that tool, again, pretty certain that it shows you the correlate or the overlap of the actual positions.
Yeah, that sounds like the same tool.
And kind of I don't want to call it a hack, but something with research reports. If there is a pay-gated research report from a journal, if I'm not mistaken, I know this applies in many science journals, and I'm not sure if it would apply in the finance space, but I do know that it's always worth reaching out to the researchers because most of them don't actually get paid for the pay-gated research reports. So if you see a research report that you want to read and it's pay-gated, you can always try reaching out to the actual original researchers who their contact information should be there, and just ask if they're willing to share it with you because they have the rights to do that. And most of them are by far very happy to share their work with you because this is, in some cases their life work that they're just happy to have people see because they themselves aren't being compensated from a lot of these journals. You could have your own whole discussion about that space. But anyway, Ben, thank you for sitting down and having this conversation. Really interesting. I love that the number of research reports you can just pull from the top of your head. That's a remarkable skill that I don't yet have, possibly because I canceled that subscription some time ago. But thank you for joining on the podcast. I really do appreciate it, and glad we could do this. It was kind of a long time coming. Really the only, I don't want to say the only finance creators, but the only two kind of bigger finance channels in the Ottawa area. It's kind of silly that it's taken this long to meet. Even our first collaboration, we didn't actually film that in person. We just shot separately and sent it to each other and collaborated online.
We talked about it in person.
Met up for coffee, talked about it, but then everything was done virtually. And funny enough, during the pandemic, and now we'll meet up and, and do it in person. But if you want to see more of Ben Felix's content, you can find him on YouTube under Ben Felix. That's his YouTube channel, Common Sense Investing. Also, the Rational Reminder podcast. I would assume available on any of your podcasting.
Yeah, it's on
websites.
YouTube too.
On YouTube as well, right?
Yeah.
Right. Yeah, they have. You have your own separate channel for
Yeah,
Rational Reminder.
separate channel.
Yeah. Anything else you'd like to shout out in terms of socials or anything like that?
No, I mean, real quick, we talked a lot about investing and financial economics and portfolio management, all that kind of stuff. The other area that I've spent a lot of time researching over the last couple of years is happiness and well-being and how that relates to money.
You've posted a lot of videos about that lately, actually, and I saw your car one not too long ago about luxury cars. So great content for research reports, but also, you've been covering some lifestyle stuff in terms of how money relates to well-being and aspects like that.
And I think that's super important.
Yeah,
like
of course.
It's fun to talk about all the stuff that we just talked about, but it doesn't let you necessarily live a good life.
Yeah, well, and that's the thing, right? Is at the end of the day, money's and investing is really just a tool for, your end goal isn't to make a lot of money. Your end goal is to be happy. And
right.
Generally people see, well, how do I get there? Financial security and stuff like that. So yeah, great source for all kinds of videos, jam-packed of research reports. I mean, it's literally in your job title, so it works out. But yeah, thanks for joining us for another podcast episode. If you have any thoughts you'd like to share, or if you like the episode, please do let us know in the comments down below. And yeah, we'll see you in the next one. Until then, cheers, and check out Ben's channel. Thanks, Ben.
Thank you, Richard.
Bye, guys. A final thanks to Noah for sponsoring this episode, and your final reminder to use code BAGEL for a 7-day free trial and 37% off the annual subscription fee. Thanks for watching.